Top wealth building strategies by net worth.
Brent, I am so excited about this because we know that in our financial journey, depending on where we are, the things that we focus on might be different. And I love that today we're going to talk about those strategies, those focus areas, depending on where you are in your wealth building journey.
Well, what I love about our channel is that we do try to give you the differentiation of when you're starting out, you're completely different than somebody who's been saving and investing for 20 plus years and is probably getting close to 7 figures.
Yep.
So today we're going to kind of lean into that a little bit extra and say, hey, wherever you are, let us give you the strategies to think about in your section of the hunt towards your first $1 million.
Now, in the strata that we're going to use today, we are going to exclude home equity. So we're really talking about your net worth outside of your home. But when you do your annual net worth statement, it's totally fine to include your net worth in there. But for the purposes of today's show, we're talking about net worth. It's not just because you bought a house in a really solid, cost of living area where the price of homes went up. This is based on where you are in your accumulation phase of building wealth over the long term.
Don't mishear us. We're all about your home equity in your net worth, but it is one of those things. I just don't want you strutting around like George Jefferson just because you happen to buy a house at the right time. We got to make sure that you can actually have assets that are working for you. Remember, your money should work harder than you do, so we want to protect you by focusing on those investments.
So let's dive right in. The very first strata we want to talk about is from a negative net worth to a zero net worth. And for many folks, this is sort of an inevitable starting point that when I come out, when I first start in my career, when I first enter into adult life and I add up all the things that I own and I subtract all the things that I owe, it turns out to be a negative number.
Yeah, and I don't want anybody, don't be scared. A lot of us come out of school with a little bit of student loan debt. You don't have a lot of assets, but guess what? You have the most valuable resource you could potentially ever want, something that your older peers will be jealous of. You have lots of time on your side, so it's okay to come out of debt with some debt. We just got to figure out, how do we pay off this debt?
Yeah, so the thing we want to think through is if we are negative, how do we get to zero? We're going to walk through. We got to pay down debt. We have to manage new debts well. We have to build our assets, and we want to make sure that we're insuring against catastrophe. And if you can do these 4 things, then there's a really good chance you're going to be able to move from a negative territory on the net worth scale up to the positive territory.
Yeah, let's see how we can get people to zero as fast as possible. So, Bo, jump us off on this paying down debt, because I mentioned student loans, but for some people, this might be consumer debt, might be credit card debt. How do we want to attack this?
You have to figure out, how do I start paying off high interest debt? Because we know that compound interest can be the 8th wonder of the world. It can be amazing when it comes to wealth building, but when it works against us, it can be devastating to our ability to build wealth. So there's actually a great piece written by Daniel in Beyond Basics that actually walks through how to pay off high interest debt. What are some ways that I can do this? He walks through methods like using the debt snowball or the debt avalanche. So if you've not checked that out, you can go to moneyguy.com/beyond-basics and check that out to see, okay, what should I do? How can I begin prioritizing getting out of this high interest debt?
This is one that I often think about. Paying down debt is one of those things. A lot of your credit card debts and other things like that, they'll charge you greater than 20%.
Yep.
So how are you ever going to get ahead if you're paying twice what you hope to make out of the S&P 500? There's something to be taken away with that. We even have a rule, Bo, that we talk about. If you're talking specifically about credit cards, credit card use, completely okay. But to make this kind of rhyme out so you'll remember it, credit card debt, no way.
Now don't mishear us. We like credit cards. We both use credit cards. But if you are carrying a balance month over month, you are doing it wrong. You might not be a credit card person. So that's a consumer side. But another debt that a lot of people fall into is auto loan debt. A lot of folks right now are buying more car than they can afford. They're borrowing more money than they should, and they're getting themselves into a pretty awful financial situation. Now, we love paying cash for cars when you can, but if you are in the negative to zero net worth, there's a really good chance that you are not going to be able to pay cash for a car. So we want to give you the tools necessary so you can make that purchase well. That's why we actually have an entire car buying checklist out at moneyguy.com/resources that will walk you through the things that you need to know before you purchase that car so that you don't fall into that statistic of folks who are driving around their net worth statement.
Yeah, I mean, look, we say it and it's worth repeating because I know that probably about 60% of you are new every month. We love the 23-8 rule. Remember, cash is king on paying for your car, but if you start like both of us did, right out of school, we didn't have enough money to go pay cash. We had to figure out what's a reasonable way to finance that first car that's going to allow us to get to our JOB, because that's going to be the engine to our wealth building force. So here's what 23-8 is you'll put down 20% down. You'll also make sure you don't finance it longer than 3 years. You're going to pay it off within that 3 years. That's going to keep you in check so that you actually, because those payments are going to feel higher, because that's where the car companies, that's where the dealerships get you, is that they say, hey, don't worry about it, just stretch it out. And you'll never own this car, but that gets your payments lower, but that also lets you buy bigger cars than you actually can afford because we want you saving and investing. We also want to make sure that your payments don't exceed 8% of your gross income. And remember, we have some overlay rules on this, is that we want those payments. You got to have your investments exceeding what those monthly payments are. And if you're ever considering buying a luxury car, think about it. If you see anything that's sitting over in Europe and you say, I would look good in that, my neighbors would be impressed by that, you better be paying same as cash, because 23-8 is reliable transportation. I'm talking about Corolla, not Land Cruiser.
And look, there's a little bit of cold water, but if you're in this negative net worth to zero, you should not even be considering luxury cars. It should not even be on your lexicon. So, okay, we got to start paying down debts. We also want to manage our new debts well. The next thing we have to do is we have to think about building assets. If we're trying to get from negative net worth to at least zero, we need to start working on the assets side of the column. And we actually have a tool that you can use, Brian. We came up with a financial order of operations. It's a 9-step tried and true process to help you figure out what to do with your next dollar. Well, and when you're in that negative net worth and you're trying to get to zero, you need to focus on the early stages. You need to focus, do I have my deductibles covered? Have I looked at all the deductibles that I have, whether it be my health insurance, auto insurance, homeowner's insurance? Do I at least have enough saved up to cover the deductible if I were to have an event in one of those categories? If you can do that, you'll prevent yourself from falling into the ditch.
Yeah, and by the way, with that highest deductible, make sure that you've got that in a high yield savings account. Let's actually make some money on that. And then that gets you into a really big wealth builder. Look, a lot of you are saying, I know you guys are talking about saving and investing, but it's the credit cards, right? Because Brian just told us it's 20 plus interest. But remember, your employer, for a lot of you, is offering you a guaranteed 50% to 100% rate of return with your employer match. Don't sleep on that. That is a huge wealth building opportunity. It's a chance for you to jumpstart. And remember, it's typically only 3 to 6% of your compensation. We're just saying get the maximum match, and then we can move on to other things. And then step 4, emergency fund. Cash is so important in the financial order of operations. It doesn't get one, it gets 2 steps in the financial order of operations, because highest deductible covered is step 1. And then step 4 is that traditional emergency reserves with 3 to 6 months.
And one of the things that emergency reserve does is it begins to help you prevent yourself from being too far out on the risk spectrum to where you cannot control your future circumstances. Because one of the things you have to do if you are in that negative to zero net worth, you have to make sure that you are insuring against catastrophe. Emergency fund is a great starting place, but it does not negate the need for insurance. So you need to work through some insurance basics. Do you have appropriate health insurance? Do you have adequate car insurance? If you're a renter, do you have a renter's policy? If you own a home, are you adequately protecting that asset? If someone else depends on your income, or if you solely depend on your income, do you have disability insurance? And if there are people that are depending on you to be here for their well-being, do you have life insurance in place? Do you have a will in place? Just because early on your focus should be on trying to get from negative to zero does not mean that you cannot focus on these things. It does not mean that these are not things that you should be putting resources towards.
Well, I think, and this is a trap for people who are in this struggle situation of trying to get to zero. They're like, look, I don't have anything, so I'm going to cut the corner off and not even really do insurance, whether it's health insurance, whether it's car insurance. Don't do that, because look, if you go look at why people file bankruptcy and other things, a lot of times it's big catastrophic life events happen, things that you don't foresee coming your way. The good news is there's ways to insure those big risks that are out there. So don't cut the corner off thinking, hey, why do I want to pay a little bit of this towards insurance premiums when that might be what gets me out of credit card debt, or that's what pays us off. Don't skip that step, because this is what's going to keep your financial life out of the ditch, is by insuring some of these big risks that are sitting out there.
Okay, Brian, that was going from a negative net worth to a zero. Now let's talk about the fun side, the other side of that equation. Let's talk about the second strata. What about net worth from $0 to $100,000? What are the wealth strategies we ought to be focusing on?
Now, first of all, congratulations. Once you get to zero, meaning you don't actually owe, you have money. Hopefully you're living on less than you make. You don't have a ton of credit card debt. You're already doing better than the 12% of the population that is pretty much stuck in some form of debt, whether it's student loan debt, whether it's credit card debt. You're already doing better than that group of people. But now we've got to get you to that bowling point, which is we've got to try to work on getting you to your first $100,000.
So what are the things that we ought to focus on when it comes to getting to 100? Well, the first is you got to finish your financial cleanup. If you do still have like lingering high interest debt, get that knocked out ASAP, and then build your emergency fund. So again, you won't find yourself getting back into that. You want to build that foundation so that you can keep yourself out of debt. And so that way you can begin focusing on the number one primary thing that you should be focusing on.
Yeah, we like to say start aggressively investing. Now look, don't mishear us. We want you not just going out there and speculating, where you're out there buying whatever the latest and greatest trend that you hear that you can't miss making money on. That's not what we're talking about. In the beginning, when we're trying to get you to your first $100,000, your savings rate is so much more important than even the investment you're choosing. So I want you to be as aggressive as possible with what you can put towards the future.
And our goal is we want you saving 25% of your gross income for the future. But if all you can do is 10%, that's great. See how you can move to 11% next year. If you're at 15%, awesome. What can we do to get to 20%? Because as you begin saving, as you begin to increase your savings rate, you get to move along in the financial order of operations. When you think about putting your dollars to work, where do you put them? Well, we've already talked about, we want you to be getting that employer match. It is free money. It's 100% rate of return. You can't miss out on that. Well, then you knock out that high interest debt. You've got your emergency fund covered. Now you get into the fun stuff. Now you get to look at the accounts where you can actually get your army of dollar bills working for you.
Yeah, I mean, I get excited when somebody tells me, hey, I'm at the point where I've got a good emergency fund. Where do I need to start investing? I love introducing people to Roth accounts. Whether it's your Roth employer plan, whether it's your Roth IRA, get in there and take advantage of this tax-free growth opportunity. Because if you do this early and often enough, there's a good chance you could be a 7-figure tax-free millionaire. And that's super exciting. So get that Roth IRA, get that health savings account, and don't skip out on step 6, which allows you to load up that employer plan too.
Now, here's what's interesting. These are all so exciting and so fun. And we have a lot of fervor when we just start first funding these accounts. But in reality, it might feel slow at first. You might feel like, oh gosh, I've been doing this for a year and I'm just not going anywhere. The numbers aren't getting big. The accounts aren't huge. Man, is this even worth it? Should I even do it? Take a deep breath. That's normal. It is supposed to feel slow at first, because what's interesting is when you can apply time over this discipline, the story gets super, super exciting.
Yeah, so let's talk about that first $100,000. This is something that I think is interesting. If you're just deliberate with your monthly savings, meaning you're going to save $10,000 annually, which I know, but go with us for this illustration. You'll see what we're saying, what we're sharing here, and making a reasonable 8% per year. A lot of people are surprised to see, yes, it's going to take 7 years and 5 months.
Just to get to $100,000.
Just to get to $100,000. And that's even with a very aggressive savings rate. But here's the thing I need people to understand. I understand a lot of life is going to happen in that 7 years. It's because more than likely, that's enough time that you're going to have an economic downturn. There's a lot of things. There's going to be elections during those periods. There's going to be lots of things where every night you're going to come home and something's going to whisper in your ear, hey, I know you're buying every month. I know you're investing. And I know you have this automatic millionaire thing going on if you just stay the course. but why don't you quit? And it happens all the time. I've had neighbors where they know what I do for a living. They see the excitement that we create, and they'll come to me and they'll say, hey, can you help me set up an account with a Fidelity, a Vanguard, and get this started? Then they'll come to me 3 months later and say, Brian, that was the dumbest thing ever because that thing can lose money. I'm telling you, do not get sidetracked in this first $100,000. That is the journey. This is so simple, but it is not easy because life is going to be out there with all these distractions. Always be buying is your friend.
But then what's the rest of the story? So we said it might take you, if you were to start at 30, it might take you 7 years and 5 months to build up to $100,000. But if you can stay the course and you can continue to save $10,000 a year and you can make on average 8%, by the time you get to retirement, by the time you get to age 65, in the last 6 months of your investing, your portfolio will have grown by $100,000. What took you 7 years and 5 months to do in the beginning, by the end of your journey, only takes 6 months if you can put in the time, if you can stay the course. So it's gonna feel slow. It's gonna feel hard. Keep plugging forward and your future self will thank you.
It is all about, in the beginning, those small decisions so you can build that great, big, beautiful tomorrow. So get through the slow part where, yes, every month is going to feel like a task, a journey to get there. But if you will do this and get to that critical mass, that launch point, and that's what our bowling point, as I like to say, and not saying very well, you will get to a point where your money can work harder than you can with your back, your brain, and even your hands.
Now, here's what you need to do also at this stage. Make sure you stay out of credit card debt. You got out of that high interest debt. Don't allow yourself, when life gets tough, to fall back into that trap. And then as you get into this positive net worth territory, you probably are doing things like making large decisions like buying a home. So even when you make a large decision like that, make sure you're doing it in a responsible manner. We actually have a rule when it comes to home buying. Before you purchase your first home, make sure that your timeline is you can be there for at least 5 to 7 years. When it comes to putting it on down payment, you don't have to do 20% down. It's okay for your first house. It's okay for your first house if you only do a 3 to 5% down payment. And then you want to make sure that you keep all of your housing costs under 25% of your gross income. If you can do that, if you can get into a home that way, there's a really good chance that you're not going to derail your financial life and be house rich, retirement poor, by doing it the wrong way.
Yeah, so make sure you go out there, moneyguy.com/resources. Check out some of these home buying guides, these other portals that we've set up to be tools for you, because this is going to help you so you can actually have a chance to build wealth outside of just your home equity. And nothing wrong with building home equity, by the way. It's just that when it comes to your money working harder for you, we need that money to be accessible and something you can use. And that's why investing really is important in this journey.
Okay, Brian, now let's talk about the next strata. We're talking about folks who have a net worth between $100,000 and $500,000, excluding the equity in your primary residence.
Now, this is pretty exciting. As soon as you get to $100,000, that puts you in the top half of the population in the United States when you look at saving and investing.
Yeah, if you're starting to see these numbers on your net worth statement, you're getting to the boiling point. You're seeing the fruits of your labor begin to pay off because you got to $100,000 and now you've given it enough time to compound. So there's a really good chance that you have mastered or are starting to master the behaviors around wealth building. Now the question is, how do I keep it going? How do I continue moving the ball forward on my wealth building journey?
So how do we get you from $100,000 to $500,000? The first thing, now look, in the beginning, when we tell people we want them to save and invest 25% of their gross income, it is aspirational because anything is better than nothing. But I do think that once you starting to get to these traction points, really hold yourself accountable. Are you saving and investing 25%? There's lots of distractions out there, but put your money to work because it's that important.
And then as your assets do reach this boiling point or do reach this critical mass, there's a good chance that you might begin thinking through like some advanced planning ideas. Maybe early on in your journey, you were using a target retirement fund, which is great. You pick the year you want to retire and how much you want to save, and that's it. But as your assets get larger, it may make sense for you to move from more of a generalized plan to more of a specific plan where you are looking at things like asset allocation. How do I spread my assets across different asset classes? Or maybe I want to look at asset location. Okay, what types of accounts between tax-free and tax-deferred and after-tax do I hold what types of investments? And do I have any unique timeline constraints? Are there things that I am beginning to bump up against, like retirement or like big expenses that I know are coming my way that I need to begin planning for?
Well, you think about it. If you think that you are just by choice choosing to be part of the FIRE movement or the FINE movement where you're going to retire early, you need to take that into account.
Yep.
You also might have a unique thing in your career. Maybe you're a pilot or you work for the FAA as as air traffic controller. There are some mandatory retirement dates you need to be aware of and plan accordingly. So understand that time is an important consideration, whatever your planning is.
And then the other thing that you ought to be thinking through is you want to reassess your insurance needs at this stage. As you go from zero net worth to $500,000 net worth, there's a really good chance your life has dramatically changed. Maybe your family looks different. Maybe your marital situation looks different. Maybe your kids are different ages. Do you still have appropriate life insurance in place? Is the health insurance that you're choosing at open enrollment every year the one that makes the most sense for you? Do you have an umbrella policy in place? Are you updating your beneficiary designations? Are you updating your wills? Are you actually looking at those things? It's very, very easy at this stage to get comfortable, to rest on your laurels, and forget to prioritize the things that need to be prioritized.
Well, nobody wants to talk about their death or the potential for their death. You also don't want to have those hard conversations with your significant other about, hey, who's going to take care of the kids if something happens to one of us or both of us? So don't skip those steps. I know it's an uncomfortable conversation, but you are getting to be, you have more and more assets. These conversations are going to get harder and harder if you don't go ahead and make the steps to start making those decisions today so that your money actually has a purpose beyond even you.
Okay, Brian, if we were talking about from $100,000 of net worth, excluding home equity, to $500,000 excluding home equity, is like getting close to and reaching the boiling point, then this next strata, I think, is officially in the boiling point. I think this is where escape velocity exists for most folks. And this is when your net worth outside of your home is somewhere between $500,000, $500,000, and then seven-figure land, $1 million total net worth.
Yeah, and we're being hard on you here. We'll tell you, I'll go ahead and share with you. This puts you in the top, 21% of the public. And remember, because we're being so conservative, we're not even counting the home equity. But in a lot of the cases, these people are likely millionaires when they look at their total net worth. But we're kind of getting excited about the fact that you have at least $500,000 of your army of dollar bills that are now have the potential to work for you harder than you can with your back, your brain, your hands. So how do we maximize this and make sure that you're doing everything you should?
Yeah, one of the things that's so exciting is that the bigger the numbers get, the bigger the numbers get. And let me show you what we mean by that. If you're a 30-year-old and you're saving $10,000 a year and you can make 8% annually on your investments, it'll take you about 20 years to get from zero to $500,000. So you've been working for a long time to get this money moving in that direction, and it is no small feat. But this, again, is where it starts to get exciting. This is where momentum begins to be your friend, because what took you 20 years to accomplish in the beginning of your journey, by the time you start closing in on retirement at age 65, in only 3.5 years, you can add $500,000. What took 20 years in the beginning only takes 3.5 years.
Well, think about it. This is the law of numbers. That at 65, this good behavior is rewarded with right under $2 million. It's $1,911,000. Yep. So when you say that, yes, the last $500,000 took 3 years, 7 months, it's because this thing is cooking. I mean, and this is why it is so slow in the beginning that you'll start doubting, why am I doing this? But if you can just stay the course, you will be rewarded. And then you get to the point, and this is why I always say, it's so unfair when you're in your 20s and 30s, you're like, I don't know why I'm going through this, because life is mean. You have the messy middle where you're short on time, you're short on money. But if you stay the course, You're going to get in your 40s. And guys, you're going to live the life you've dreamed of, because now your money is going to start doing all that hard work. Your vacations are going to get a little bit better. You're going to be able to make life decisions because you own your time that much sooner. This is why we stay the course in our 20s and 30s. You still bedazzle your basic life so you're not living a miser life. You're living that financial mutant life, but don't skip this step.
So how do we do it? How do we stay the course? How do we begin moving from that $500,000 net worth or wherever we are towards that $1 million net worth? Well, I think the first thing is you have to make an assessment. Am I in the make wealth phase of my journey, or am I in the maintain wealth phase of my journey? Because those two phases are very, very different when it comes to wealth building.
Well, yeah, you look at risk completely differently. When you're in the make wealth, you obviously should balance the risk reward, even when you look at debt payments and so forth, because you're like, hey, what's the incremental decision difference of if I go get this in my 401k versus prepaying my mortgage or other things that are out there. However, once you're in the maintain wealth stage, this is the part where you say, hey, it's not just about maximizing every dollar that comes into my command. It's also, how do I de-risk my portfolio so that there's nothing that can derail all this hard work, all these assets that have been built up, so I don't make silly decisions or stupid decisions that kind of knock this whole thing away and keep me from staying wealthy.
It's not about how much you make, it's about how much you get to keep over the long term. Another thing that you might begin doing in this phase is you might be considering more advanced tax strategies if you've not started that yet. This might be backdoor Roth contributions, or maybe some sort of Roth conversions, or maybe through your employer you have mega backdoor opportunities, or you want to start looking at that after-tax account that's now getting larger. Should I start thinking about capital gain avoidance strategies, or should I look at loss harvesting? Are there ways I should do charitable planning with appreciated assets? As your portfolio gets bigger, as the numbers in general get bigger, some of these advanced strategies might be more valuable to you than they may have been 10 years prior in your wealth building journey.
Well, and this is a good conversation I always have with people, is that because when you're talking about the get wealthy versus stay wealthy behaviors, a lot of people who get wealthy, they did it through risk. I think about my entrepreneurs, I think about my real estate investors. They think they're cowboys. I mean, they can handle whatever comes their way, but I always have to have that hard conversation that says, hey, look, you have done a great job of building wealth, but now we have to start thinking about this a little differently. And risk capacity, because I think most people, we think in terms of risk tolerance, meaning how much can you emotionally handle before you say uncle and you actually head for the exits on it. That's what happens when you do your first investment portfolio. The person who's helping you out with that, or you're doing a 401k enrollment meeting, they'll talk about risk tolerance. But I tell you, once you get into that maintain or stay wealthy phase, there's a different risk element. It's called risk capacity. And what we mean by that is that, yes, you might have the tolerance to ride through any wild thing from an emotional standpoint. However, you might be to the age now that you don't have the time for the money to actually recover. It's easy to talk about recovery in the 20s, 30s, and 40s because you have decades before you actually need these assets to live off of. When you get closer to retirement, or actually are in retirement, it might take you 6 or 7 years to recover everything that you might have lost in the next economic downturn. That is a problem, and that's why risk capacity is just as important in your planning as risk tolerance is.
This is another facet of that same coin. As you think about risk and the things that could take you off track, as you're moving towards 1 million, one of the things you should do is reconsider your cash position. Am I actually holding enough liquidity so that I can do the things that I want to do? We see far too often folks will get to $1 million of net worth outside of their home, which is an incredible feat to get to, but they are not liquid at all. Meaning if they want to go buy a new car, they need to replace something at the house, they have to go borrow money to do that. So as you're moving from 500,000 to 1 million, you may just want to assess your liquidity needs. Do I have liquid capital available and ready should I need to access it in the near to intermediate term?
I'll be the cold water here. Lifestyle creep.
No, this
is one that I think I want you to be honest with yourself about your lifestyle inflation. I think it was when you're getting close to this 7-figure mark. you're going to start feeling better because you do start to see those quarterly reports where now your assets are moving faster than even your savings rate. And you'll be like, well, now I can kick it up a notch. And maybe, I say that's why we have the Know Your Number course and other things that we're always trying to educate people. But you got to do the homework to actually know, are you ahead of the curve on this? Is because what I worry about is people feeling like, hey, I'm at the point where I've built up, $600,000 in assets. Maybe I can afford a nicer home. Yeah, I can move the goalpost again.
Easy to justify.
Yeah, you
that.
can, because just because you can doesn't mean you should. I would really encourage you, spend some time knowing what makes you happy, what makes you tick, even without financial resources involved. Like, what actually makes you happy, so that you can kind of, once you understand that, you won't be susceptible to somebody whispering in your ear, hey, you ought to get the super nice car. You ought to get the bigger house. Now, maybe some of these luxuries are a good thing for you, but I don't want you to do it at the expense of your future self. So make sure you measure twice, cut once on these big decisions.
If I'm hearing you say this, brother, there's nothing wrong with lifestyle creep or lifestyle inflation so long as it's not robbing from your future self. It's an okay thing to have happen. And that's so important even as we get into this next strata, because the next strata is the exciting one. It's the one that gets all the headlines. It's the one that gets the press. This is when your net worth, excluding your primary residence, gets into seven-figure land. You are now officially a millionaire in terms of the wealth that you've built to this point.
Yeah, this one puts you, once you have this, you're in the top 12%.
This
of
is
the United
rarefied
States.
air up here.
Yeah, and by the way, if you go into liquid net worth, this number gets even, it gets below 5%. So that's an incredible thing when we talk about this. And I know there are some naysayers out there. They'll look at this and they'll say, hey, we just came through a big inflationary period. You guys are still talking about $1 million. We've moved on from that. Now we're at 3 million. We're at 5 million, 10 million. I can tell you, you realize we've done all this content where we show you this gets easier and easier because once it gets to a certain critical mass, the money grows upon itself. I can tell you this, as soon as you get to your first million, that second million happens that much faster. It's very quick. The third, fourth, fifth, you don't get to 5 million without $1 million first. You don't get to 10 million without that first million. Don't sleep on this. And also, don't let somebody tell you, hey, just because the goal has moved to 3 million, don't worry about this or give up. You can do this.
Another common fallacy, and we see this all the time, is that someone assumes that, okay, now that I've gotten to 1 million, I need to do something different. I need to change something about how I'm built. See, Brian, I played baseball growing up, right? And I had coaches that would always say this. We'd get to the tournament, we get to playoffs, we get to state, we get to whatever it is, and we would get there playing ball a certain way. We had a certain strategy, we did it a certain way. And he would always say to us, boys, don't forget to dance with the one that brung you. Don't forget the thing that got you to where you are. Don't assume that just because you are here now, you have to do something different. And so often we see people do that. So often they think, because now I have $1 million, I've got to do something more aggressive, more risky, more sophisticated, more fill in the blank. That's not the case. It's okay to continue building wealth the boring way, even when the numbers get big.
Yeah, and by the way, just because you reach millionaire status, especially liquid millionaire status, don't let somebody try to sell you on some doctor deal because it's sexy or has a sizzle. This is what other rich people do. We deal with a lot of millionaires, and there's nothing wrong with that boring, low-cost index fund. There's nothing wrong with that risk-adjusted, low-cost portfolio that you're dealing. There's nothing wrong with, just thinking about basic tax planning, not getting into something so sophisticated that it's really spinning your head. And you're like, this is so complex. I don't even understand what we're doing anymore. You can actually be successful with a lot of the same behaviors that got you to that seven-figure status.
Yeah, none of that changes. Living on less than you make, thinking about risk, focusing on the things that you can control, like taxes, focusing on your behavior, how much I'm saving, am I still putting my money to work? Those things are still great. But even considering that, reaching 1 million could mean it's time to start adding stuff, not changing what you're doing, but as you get to that phase, as you get to that stage of your wealth building journey, there might be some things that you want to consider. Like early on, you're focused on accumulate, build. as the assets get bigger and as you start to move into that place, now you're beginning to think about the finish line. What does the finish line look like? What am I actually working towards?
Yeah, are you ahead of the curve, behind the curve, or right where you need to be? Because this is where I don't want you to be that financial miser where your loved ones are saying, why do we still stay this way? Why are we doing it this way? And it's actually taking away from the happiness or the memory building opportunity. So actually do the work of knowing, are you ahead of the curve? Because then maybe you can pull back a little bit on what your savings rate or your investment rate, maybe live a little bit more, but don't skip the step of actually doing the work of knowing your number. And that's why we actually created that course and the tool at learn.moneyguy.com.
Yeah, this is a great thing. If you can define what you want your future life to look like, you can put this into the tool and it will actually tell you, okay, what's required for me to get from where I am now to where I want to be in the future. And it defines that finish line for you. Another thing that you can start thinking about is as you start to reach this 7-figure land, and as your net worth grows above $1 million, now you can begin focusing not just on the make wealth or the get wealthy behaviors, but now you get to focus on the maintain wealth or the stay wealthy behaviors. And those are, at this stage, just as important as the make wealth behaviors were early on in your journey.
Yeah, I mean, there's nothing wrong with when you're in the stay wealthy phase to de-risk your life. And that might even make sense to pay down low interest debt. There's nothing wrong with that. It also might mean that you have this glide path or understanding that your portfolio is going to be a little bit more conservative so that risk capacity issue doesn't come up and bite you because you just don't have as much time to wait for recovery. And then don't forget, always amazed, more than likely, this is your first journey into building 7-figure status. And you don't have a lot of blind spots. You have people selling you on stuff and you just like, I just don't know what I don't know. Or you're busy because you are a successful person, so there's a lot of obligations going into that. There's nothing wrong with bringing in somebody, taking the relationship to the next level. I would ask you, hey, remember the abundance cycle. Who planted the seeds? Who taught you to learn, to apply these concepts of good financial management and helped you grow to the level that you are? I'd love for you to pay it back to us through the abundance cycle. Go check us out at Work With Us. You can go to moneyguy.com. We have all kind of, or even aboundwealth.com. We have great resources for you.
And then one of the other things, again, as you get to this stage, as you have $1 million net worth outside of your home, you may begin at this stage thinking about new accumulation opportunities. Is this the time when I want to get into real estate? Or do I want to think about starting a business or investing in a small business? But you need to make sure that you measure 2, 3, 4 times before you do this. Because again, you're not changing the strategies that got you to where you are. You're just recognizing that in addition to what I am doing, maybe now there are other things I could be doing as well.
Yeah, we love creating this type of content. I would encourage you all throughout the show. We've shared this, but I'll put it out there even more. moneyguy.com/resources. We'd also love subscribe to us. Whatever media that you're watching, whether it's podcasts, whether it's YouTube, just give us a follow because we love to load you up with free content. The biggest thing when you think about what true wealth is, it's to be able to spend your time focusing on doing what you want on your terms. That doesn't happen by accident. You have to be very deliberate. So take control of your finances today. I'm your host, Brian Preston, Mr. Bo Hansen. Money Guy team, out.